Buying properties and building up a property portfolio in your personal name may not be the smartest idea. The first reason is asset protection. Having all the properties in your personal name means that they are now subject to personal risk. So if something goes wrong with you in your personal life, those properties are affected. The second is tax. Income tax in a personal name in South Africa is on a sliding scale from minimal all the way up to 45%. Now, if you have a property portfolio that pays you monthly, all of that income is going into your personal bank accounts, which then becomes susceptible to the increase and sliding scale up to 45%. This is pay as you earn tax. And the third is estate planning. We all want to build up a legacy for the next generation. But housing all the assets in our personal name means that those assets are subject to estate duty exposure or death taxes when we pass away. So something to consider is a trust structure. And not merely a trust structure, but a trust that owns a property company. Now, a trust is great because it gives you that asset protection, because nobody can own a trust. A trust also gives you the estate planning. Because assets held under a trust structure are not owned by you, they are then separate from your personal estate and can be handed down through generations. However, holding all assets into a trust may not be the most tax efficient way to do things, as trusts are taxed heavily with income tax at 45% and capital gains tax at 36%. So something to consider is not a standalone trust, but a trust that owns a property company. The property company then purchases the assets. Now, a company is taxed differently, with corporate tax on profits at 27% and capital gains tax at 21.6%. You can now see that housing properties at company level protects them via the trust and also becomes better from a tax position, as you get taxed at 27% and not necessarily all the way up to 45% in your personal name. Not only this, but the properties can be expensed within the company, as well as being used as leverage to purchase and acquire more properties, all outside of your personal name. If you're now wanting to take cash out of the property company into your personal name, there will be taxes on this sliding scale. However, having it under a structure allows it to be in a much more controlled format. Now, if you already have properties in your personal name and you're wanting to move towards this structure, that is also possible. There's something called asset for share transfers, where you can transfer your assets to a company in exchange for qualifying shares in that entity. These can be complex transactions, so you must always consult a professional. But what that may allow is for you to transfer your properties to this company in exchange for a share, and that transaction may not trigger capital gains tax or transfer duties. The growth of the properties, if structured correctly, then could happen under the trust and not in your personal name. All in all, this approach gives you asset protection, estate planning, and some nice tax efficiencies. Remember, the setup of these structures is pertinent, so always consult a professional.